In 1990, the median American home cost about 3 times the median income. Today, in many cities, it's 6, 7, even 10 times. Groceries feel heavier. Insurance renewals quietly climb. College tuition doesn't rise, it compounds. Maria works full-time in Phoenix. 10 years ago, her rent was manageable. Now it absorbs nearly half her paycheck. She didn't stop working, she didn't downgrade her ambitions. But the numbers moved faster than she did. Individually, every increase sounds reasonable. Supply chains, labor shortages, global instability. Together they feel structural. Wages have grown. But not like housing, not like healthcare, not like assets. So here's the tension. If productivity improved, if technology advanced, if the economy expanded, why does it feel harder to stand still? But that still doesn't explain why nearly everything, from shelter to cereal, resets higher at the same time. What changed beneath the surface? The common explanation is straightforward. Pandemics disrupted supply chains, factories slowed, shipping costs surged, stimulus checks increased demand, consumers spent quickly, prices adjusted upward. At the same time, labor markets tightened. Businesses raised wages, higher payroll costs flowed into final prices, energy prices spiked, fuel became more expensive, transportation costs rippled outward. All of that makes sense. Inflation happens when demand outpaces supply, or when shocks hit production, or when governments inject liquidity too fast. That explains the moment, not the pattern. Because prices didn't just jump once, they stair-stepped, then stabilized at higher levels. And this wasn't limited to one sector. Housing rose before the pandemic. Tuition was compounding for decades. Healthcare costs climbed steadily through multiple administrations. Here's what most people miss. Temporary shocks create spikes, but structural forces create floors. And once the floor moves, it rarely comes back down. So the question returns, sharper now. Why do the floors keep rising? Across industries that don't share the same supply chains, something is linking them. But it's not where most people are looking. Step back from the supermarket aisle. Zoom out from Maria's rent in Phoenix. Look at a longer timeline. In the early 1980s, under Paul Volcker, interest rates were pushed above 15%. Borrowing was expensive. Credit was tight. Money had weight. Then something shifted. For 4 decades, rates trended downward. Each slowdown was met with lower borrowing costs. Each crisis was cushioned with liquidity. After the 2008 collapse, central banks expanded balance sheets at historic scale. Capital became cheaper. Not temporarily, structurally. Now widen the frame again. In San Francisco, housing prices accelerated alongside falling mortgage rates. In New York City, asset values climbed while bond yields compressed. This wasn't about one city. It was about the price of money itself. When credit becomes abundant, assets respond first. Homes, stocks, private equity, land. Cheap money flows toward anything that can store value. And once those assets reprice higher, they don't easily deflate without breaking something else. Maria wasn't just competing with other renters. She was competing with capital. The question from the beginning shifts form. If productivity improved, why is standing still harder? Because it wasn't goods that inflated first. It was assets. It wasn't inflation chasing products. It was capital chasing collateral. Money didn't simply become cheaper. It became easier. But that still doesn't fully explain why groceries, insurance, and tuition eventually followed. Why did asset inflation spill into everyday life? That's where the mechanism tightens. Here's where the mechanism locks in. When interest rates fall, asset prices rise. Higher asset prices increase collateral values. Higher collateral allows more borrowing. More borrowing fuels further asset demand. That's the surface mechanism. But beneath it sits a reinforcing loop. As homes appreciate, landlords pay more to acquire them. To justify the purchase, rents must rise. Rising rents validate higher property valuations. The loop closes. The same pattern appears in healthcare. Large hospital networks borrow cheaply to expand. Expansion increases regional dominance. Dominance increases pricing power. Prices rise. Revenue grows. Debt is serviceable. And lenders prefer stability. Here's the structural pivot. It wasn't that everything became expensive. It was that assets became central. When housing is primarily shelter, prices anchor to income. When housing becomes a financial instrument, prices anchor to capital flows. That's the shift. If cheap credit inflates assets, and essential services are delivered through asset-heavy systems, then protecting asset values becomes systemically important. And if stabilizing the economy requires protecting asset values, then policies will tilt toward preventing those values from falling. If X depends on Y and Y depends on Z, then stabilizing Z requires protecting X. No one designed it as a trap, but once formed, it protects itself. This is the inevitability. Lower rates raise asset prices. Higher asset prices raise baseline costs. Higher baseline costs make rate hikes dangerous. So policy oscillates carefully, but rarely resets the floor. Remember the original question? If productivity improved, why is it harder to stand still? Because your paycheck competes in a system calibrated to defend asset valuations, not to restore yesterday's prices. And once the economy organizes around asset sensitivity, price floors harden. That's not a conspiracy. It's an architecture. At the beginning, Maria was just trying to keep up in Phoenix. Her rent rose, her groceries rose, her insurance rose. It felt personal. It wasn't. We asked a simple question. If productivity improved, if technology advanced, if the economy expanded, why does standing still feel harder? Because the system didn't optimize around affordability. It optimized around asset stability. When money became easier, assets repriced. When assets repriced, baseline costs moved. When baseline costs moved, everyday life recalibrated upward. And once essential systems, housing, healthcare, education, became deeply assetized, lowering prices meant threatening balance sheets. So the floor rises, slowly, then structurally. Maria isn't just paying for shelter. She's paying inside a capital-sensitive architecture. Her paycheck floats, asset values anchor, and anchors rarely drift downward by choice. So the real question was never just, why is everything so expensive? It's this: what kind of system makes higher prices safer than lower ones? Because in a system built to defend asset values, affordability isn't the priority. Stability is. And stability, once defined by rising asset floors, has gravity.